Ever wondered how interest rates affect your loans? Well, it's time to demystify the concept. Picture interest rates as the cost of borrowing money. They're the price you pay for the privilege of using someone else's cash. Typically, a bank or other financial institution sets these rates, influenced by a myriad of factors, including the economy's overall health and inflation. Now, interest rates aren't a monolith. There are two distinct types that you should be aware of: fixed and variable. A fixed interest rate remains constant throughout the loan period, giving you predictable payments. On the other hand, a variable rate can fluctuate over time, following the ups and downs of market interest rates. These interest rates play a crucial role in the financial market, shaping everything from the cost of your home loan to the return on your savings account. So, as we've seen, interest rates are more than just numbers. They're powerful forces that drive the world of finance. Now that we understand what interest rates are, it's time to delve into how they impact loans. Interest rates are like the price tag on the money you borrow. They dictate how much you'll end up paying back in addition to the initial sum. When interest rates are high, the cost of borrowing skyrockets. This means for every pound, dollar, or yen you borrow, you'll be paying back significantly more over the life of the loan. Now imagine the opposite scenario. When interest rates are low, the cost of borrowing is reduced. You still pay back more than you borrowed, but the extra amount is less burdensome. It's akin to a discount on your debt. But it's not just about the cost of new loans. Changes in interest rates also affect existing loans, especially those with variable rates. If interest rates rise, so does the cost of your loan. Suddenly, your monthly repayments might be more than you budgeted for. On the flip side, if interest rates fall, your repayments could shrink, leaving more money in your pocket at the end of the month. Let's take a moment to consider fixed-rate loans. These types of loans are not affected by fluctuations in interest rates. The rate you agree to at the outset is the rate you'll pay for the duration of the loan. It's a bit like locking in the price of a commodity before a market surge. But remember, while a lower rate might seem appealing, it's not always the best choice. A lower rate often means a longer repayment period, which could result in you paying more over time. Conversely, a higher rate might be daunting, but with a shorter repayment period, you could end up paying less overall. In essence, the interplay between interest rates and loans is a balancing act. The ultimate cost of a loan hinges on this delicate equilibrium. It's clear that interest rates play a pivotal role in determining the cost of your loans. But what does this mean for you? Understanding the impact of interest rates on loans is crucial for your financial health. We've taken a deep dive into the world of interest rates and loans, but what does this all mean for you personally? Well, let's start with a simple fact. When you borrow money, you're not just paying back the amount you borrowed, you're also paying an extra charge, the interest. This is the cost of borrowing money. The rate of this interest can significantly affect your monthly payments and the overall cost of your loan. Imagine you have taken out a loan to buy your dream car. If the interest rate is low, your monthly repayments will be manageable and the total cost of your loan affordable. However, if the interest rate is high, your monthly payments could be significantly higher, making the loan much more expensive in the long run. But don't worry, understanding interest rates can actually work to your advantage. By keeping an eye on the market trends and the economic climate, you can predict when the rates might rise or fall. If you're planning to take out a loan and the rates seem to be on an upward trajectory, it might be wise to borrow sooner rather than later. On the other hand, if you're already repaying a loan and the interest rates fall, you could consider refinancing your loan to take advantage of the lower rate. Refinancing simply means replacing your current loan with a new one, but at a lower interest rate. It's also important to consider the type of interest rate on your loan. A fixed interest rate stays the same throughout the loan term, giving you certainty about your repayments. A variable rate, however, can change over time, usually in line with the market interest rate. So, the next time you borrow or pay off a loan, remember the role of interest rates. They might seem complicated, but with a bit of knowledge, you can use them to your advantage. Before we wrap up, let's quickly summarize what we've learned today. We've delved into the world of interest rates, unraveling their essence and their profound impact on loans. It's crucial to grasp this concept, as it directly affects your financial decisions. We've also explored the personal implications, emphasizing the need for financial literacy and critical thinking, and that's it for today. Remember, knowledge is power, especially when it comes to your finances. Until next time, keep learning and stay financially savvy.